why you prefer value add over ground up multifamily.
I think ground up multifamily can make a lot of sense right now. Prices are insane, and I can see the value of building premium product in fantastic locations at a price that you probably couldn't buy it for on the open market. Obviously, building ground up takes a lot of expertise, a lot of time to entitle and build, and a very deep balance sheet to make all of that happen. But yeah, I think building is great. There's also advantages to buying existing assets. Usually you're buying at a discount to replacement cost. You don't have to wait. It's right here. It's right now. And I mean, costs have gone up so much. If I'm buying a 2009 asset at a discount, maybe it's not as big a discount to replacement cost as I would like, but it still is a discount, and it's right here, right now, and ready to be upgraded. So there's benefits to both. But you're right. I mean, at a certain point, I don't necessarily want to buy a 1980s deal in an okay location for $250 a door. That doesn't make sense. I'd rather do something else. One last comment is, if you're looking in Austin, Texas, for example, sometimes that 1980s build deal is $300 a door because it's in a location where that much land doesn't exist anymore, and it becomes a covered land play, and you're cash flowing, probably limited cash flow, but you're still cash flowing, writing appreciation. And then 10 years from now, 20 years from now, should you so desire, you can tear down some or all of that property and build something totally new and totally different.
Perfect. Yeah, I love that.
Yeah, Mitch, I would add to that too, because it's near and dear to my heart, the ground up. But back to Craig's point here, time is everything in real estate. Right, especially now with the Fed coming out and threatening the 4 hikes this year. We'll see how that goes. But my projects take 9 months to even get the permits to build. Right, then we talk another 12 months for phase 1, 3 years across the whole board, and there's a lot of risk in that. And commodity prices are way more. We have more exposure to the commodity prices. Right, Craig has got half his building already there. Right, so that cost basis is from like 1980. Right, so he's not having to deal with steel and foundation pours and all the craziness of that we have to deal with. Now, naturally, we have bigger margins, but lower margins in his deals equals higher safety in a lot of ways. Right?
I think you nailed it, right? It's risk reward, just like with anything else, right? So there's definitely a higher pop, and you've got that immediate cash flow and the opportunity to enhance that cash flow and get up to those market rents. So that kind of brings us to our next segment, which is, what is the best way to actually evaluate these multifamily deals? Specifically, how do you take that lens, that sell side equity research analyst lens, and bring that to the multifamily space specifically? What are perhaps some of the key criteria that you look at?
A lot goes into that. It's sort of taken me 7 years of being in the business to really develop a sense for value. I started out doing a lot of underwriting and still do a lot of underwriting, but it's sort of become more intuitive now. But we look at price per door versus monthly rent. What's our price to monthly rent multiplier? I used to think 100 times monthly rent was good. It obviously depends on if you're buying luxury where your margins are higher versus more low-end product where your margins are lower. That'll affect whether I want to pay 70 times monthly rent or 130 times monthly rent. It's not just based on current rent, it's based on also on prospective rent. Where can rents go if we execute our value add plan? Obviously, we look at price per foot and price per door and relative to replacement costs and construction costs. We look at sort of the underlying dirt value. Is it location, location, location? Is a lot about real estate. Certainly when you're buying higher priced properties or more expensive per door. Is this a location that can continue to grow? We look at a lot of data, things like population growth in the market, job growth in the market. We look at median household income to understand how much our potential customers can afford for certain amenities and upgrades that we might bring to a property. We look at the median home price in the area. How much does it cost to rent versus the cost of ownership? We look at school ratings to understand who our customer might be and whether top tier schools are something that might continue to be a driver, and over, sort of the overarching theme is I don't want to buy in places that are shrinking. I want to buy in places that are growing. So sort of where are people from California moving to is sort of been an underlying, tenet of my investment thesis. We're buying in Texas. We look a lot in Florida, the Carolinas, Vegas, Phoenix, Denver, Salt Lake City. Those are all sort of great markets. We don't own in all of those markets today, but Texas has been a big focus for us. So that's a sort of a lot of information, but